Welcome back to the channel. In today's video, we're diving into an important yet often overlooked concept: inflation. On the surface, inflation seems fairly simple. It refers to the rising cost of goods and services over time. But understanding how inflation impacts your investments is crucial for long-term success. To start, let's define inflation a bit more. At its core, inflation represents a decline in the purchasing power of a given currency. This occurs when too much money is chasing too few goods, causing prices to increase across the broader economy. In the US, the Federal Reserve aims for an inflation rate of around 2% annually as part of maintaining a healthy economy. However, inflation can vary significantly in different periods. For example, in the 1970s, inflation spiked to over 10% due to rising oil prices. And during the COVID pandemic in 2020, inflation actually fell below 0% as demand plummeted. The key is that prices are always fluctuating to some degree. So why should we care about inflation? The insidious effect is that it slowly but surely erodes the purchasing power of your savings and investments over decades if not addressed. Inflation plays a pivotal role in shaping the actual returns on your investments. Consider this scenario. Let's say you've made a conservative investment earning a consistent 3% annual return. Initially, it might seem like a decent profit. However, if the inflation rate is around 2.5%, your real return, known as the nominal return, diminishes significantly. The real return, or the actual purchasing power gained, is the nominal return minus the inflation rate. So, even though your investment is showing a 3% return, the purchasing power of that return after accounting for the 2.5% inflation rate leaves you with a mere 0.5% increase in real wealth. Over the long term, this discrepancy can substantially impact your ability to achieve financial goals. Investments that don't outpace inflation can erode the value of your money, affecting savings for retirement, education, or other major life events. This phenomenon is particularly critical for long-term investments like retirement funds, where preserving purchasing power is vital. To counteract the inflation effect, it's crucial to seek investments that not only generate returns but also outpace or at least keep up with inflation rates. Choosing assets with historically higher returns than inflation, such as equities or real estate, can be part of a strategy to mitigate the impact of inflation on your investment returns. Understanding this impact is fundamental for investors to make informed decisions and select assets that have the potential to maintain or grow their real value over time. This is where understanding how different asset classes tend to perform during inflationary periods becomes important. Cash savings accounts are usually the biggest losers, as the interest earned often fails to outpace rising prices. The same can be true for fixed income investments like bonds that make set payments. The value of those payments declines with inflation. Stocks, on the other hand, have historically provided a strong hedge against inflation. This is because publicly traded companies have the ability to raise prices on their goods and services along with overall inflation, protecting their value. Certain sectors like energy and commodities directly benefit. Real estate can also hold value well during inflation booms. Commodities like oil, natural gas, agricultural goods and precious metals often act as a strong inflation hedge as their prices directly correlate with the cost of living. During high inflation, commodities tend to maintain or increase their real value. You can gain exposure through commodity ETFs or mutual funds. Real estate, for example, physical property values usually track inflation over the long run. Rental income from apartment buildings, office spaces, storage units, etc., can potentially rise with inflation. Right ETFs provide diversified real estate market exposure. Real estate can preserve spending power when prices are increasing. Timberland, like other real assets, timberland maintains value and generates returns closely correlated with inflation. As construction activity increases with rising costs, the price of lumber and forest products follows suit. Timberland funds invest in tracts of timber-producing properties, benefiting from the inflation linkage. So in summary, the key is owning assets that will retain purchasing power rather than losing it to rising prices. This means emphasizing growth-oriented stocks and real assets over cash and bonds for the long haul. It also means rebalancing your portfolio periodically to maintain the appropriate mix. Some additional tips consider including Treasury inflation-protected securities, Tips in your bond allocation to provide inflation-indexed returns. Gold and other commodities can also act as portfolio stabilizers. And don't forget to factor inflation into your retirement planning assumptions. Now that we understand inflation and how it has an impact on your investment, let's go over some strategies you can use to guard your investment from inflation. Step 1. Invest in inflation-protected securities. Tips. Treasury inflation-protected securities, TIPS, are bonds issued by the U.S. Treasury designed to provide protection against inflation. TIPS, principal adjusts with inflation, and the interest payments rise with the principal value. Step 2. Stocks and equities. Historically, stocks have shown the potential to outpace inflation over the long term. Companies have the ability to raise prices in inflationary periods, which can lead to increased profits and, consequently, stock value appreciation. Step 3. Real estate investments. Real estate, particularly income-producing properties, can serve as an effective hedge against inflation. Rental income and property values tend to rise with inflation, helping to preserve wealth. Step 4. Commodities. Investing in commodities like gold, silver, oil, or agricultural products can act as a hedge against inflation. These tangible assets tend to retain value or appreciate during inflationary periods. Step 5. Diversification. Maintaining a diversified portfolio across various asset classes can help spread risk and protect against the impact of inflation. A diverse mix of assets can include stocks, bonds, real estate, and commodities, each potentially responding differently to inflationary pressures. Step 6. Inflation-adjusted contracts. Some contracts, such as certain employment contracts or annuities, may have clauses that adjust payments based on inflation rates, offering a safeguard against inflation's adverse effects. Step 7. Regular review of investments. It's crucial to periodically review and adjust your investment portfolio to adapt to changing economic conditions and inflation rates. Rebalancing and adjusting allocations can optimize your portfolio's performance against inflation. By incorporating these strategies, investors can better position themselves to navigate inflationary environments and safeguard their portfolios against the erosive effects of rising prices. Adapt these strategies based on your audience's familiarity with investment concepts and offer specific examples or case studies to illustrate the effectiveness of each strategy in hedging against inflation. Inflation is a critical factor influencing the value of our investments and savings. Understanding its impact is pivotal to protecting our financial well-being. It's not just about maintaining the value of our money, it's about ensuring our investments outpace the rising cost of living. Remember, inflation erodes the purchasing power of money over time. However, by implementing strategic investment choices and staying informed about inflation's effects, we can safeguard our financial future. Diversification across asset classes, consideration of inflation-protected securities, and smart allocation of investments are key tactics in hedging against the erosive nature of inflation. Remember, it's not about timing the market perfectly. It's about time in the market and making informed, strategic decisions. Stay informed, stay diversified, and remain adaptable. By doing so, you'll be better equipped to navigate the ever-changing financial landscape and ensure that your investments remain resilient in the face of inflation. Thank you for joining us on this journey to understand the impact of inflation on investments. If you enjoyed this video, remember to like, share, and subscribe to Money Matters. Mastering Finance and Investment for more insights on securing your financial future. Stay tuned for our upcoming videos and as always, stay financially savvy.